Tuesday morning, you check your investment account. Same routine. Coffee in hand. Yesterday's gains $412. You stare at the number. Yesterday you worked 8 hours, commuted, sat in meetings, answered emails. Your take-home pay for that day? After taxes, $320. Your money made more than you did. While you were at work, your investments were working harder. And then it hits you. This isn't a fluke. This is happening more and more. The lines are crossing. I'm Max, and today I'm showing you the exact moment when you win the game. It's called the crossover point, the day when your investment income permanently exceeds what you need to live, when work becomes optional. Most people will work 40 years and never even know this moment exists. They'll trade time for money until they're 65, then hope Social Security is enough to scrape by. But there's another path, a mathematical inevitability that once you understand it, changes how you see every dollar. Subscribe, because what I'm about to show you is the invisible milestone that separates economic slavery from true sovereignty. Let me show you the two lines. You have two financial lines in your life. Line 1, your expenses. What it costs you to live each month. Rent, mortgage, food, transportation, insurance, everything. For the average American household, $5,000 to $6,000 per month. Line 2, your investment income. What your money generates for you passively. Dividends, interest, capital appreciation. For most people starting out, this line is basically flat. Zero. Maybe you've got a few thousand in savings earning 3%, generating $10 a month. That's not moving the needle. But here's what most people don't realize. As you invest consistently over time, that second line starts to curve upward. Slowly at first, almost imperceptibly. But compound interest is an exponential function, which means the growth accelerates. That investment income line isn't rising in a straight diagonal. It's rising in a curve that gets steeper and steeper the longer you stay in the game. And the crossover point is the exact moment when your investment income line crosses above your expense line, when work becomes optional. Let me put real numbers on this. Let's say your monthly expenses are $4,000. That's $48,000 per year. At a 4% safe withdrawal rate, which is the standard rule for how much you can sustainably pull from a portfolio indefinitely, you would need $1.2 million invested. That's your crossover point number, $1.2 million. I know what you're thinking. Max, I'll never get there. But let's run the math because I think you'll be surprised. You're 30 years old making $60,000 a year, investing $500 a month. Average annual return, 8%, which is below the historical average of the S&P 500. Here's what happens. After 10 years at age 40, you'd have $91,000. Annual investment income at 4%, $3,600, or $300 per month. Barely a dent in your $4,000 monthly expenses. The lines are nowhere close to crossing. But keep going. After 20 years at age 50, you'd have $275,000. Investment income, $11,000 per year or $900 per month. Still not enough, but the gap is closing faster now. After 25 years at age 55, you'd have $430,000. Investment income, $17,000 per year, $1,400 per month. And here's where the curve really starts to steepen. After 30 years at age 60, you'd have $670,000. Investment income, nearly $27,000 annually. You're now over halfway to your crossover point, generating over $2,000 passively per month. At this rate, you'd hit the crossover point of $1.2 million around age 65, right at traditional retirement age. Now you might be thinking, so I invest for 35 years and retire at a normal age? What's so revolutionary about that? And here's where I need to challenge everything you've been taught. That scenario I just described, investing $500 a month for 35 years, that's the slow path. That's what happens when you invest a relatively modest amount and wait for compound interest to do all the heavy lifting. But the crossover point isn't a fixed destination. It's a function of two variables, your investment portfolio and your expenses. And here's what most people don't realize. Reducing your expenses moves the crossover point from both directions. Let me show you what I mean. In our first scenario, you had $4,000 in monthly expenses requiring $1.2 million to cross over. But what if you optimized your life and got your expenses down to $3,000 per month? Now your crossover number is only $900,000. You just knocked $300,000 off your target, which at our investment rate saves you about 7 years of working. And it gets better. If your expenses are lower, you have more money available to invest. Instead of investing $500 a month, maybe you can invest $1,000. Let's run those numbers. $1,000 per month at 8% for 25 years gets you to $860,000. Add in the lower expense target of $3,000 a month, meaning you need $900,000, and suddenly you're crossing over at age 55 instead of 65. You just bought yourself 10 years of freedom by making two adjustments: spending less, investing more. And here's where people really underestimate the leverage they have. What if you got radical about it? What if you house hacked and eliminated your housing payment? What if you moved to a lower cost of living area? What if you got your monthly expenses down to $2,000? Now your crossover number is $600,000. At $1,000 per month invested, you'd hit that in about 18 years. But you could be financially independent in your late 40s, maybe earlier, if you increased your investment rate over time as your income grew. The crossover point isn't some distant fantasy reserved for tech millionaires. It's a mathematical certainty that you can dramatically accelerate by attacking both sides of the equation. Now let me show you what happens psychologically. When you first start investing, every dollar you put in feels like a sacrifice. It's money you could be spending on things you want right now. You're delaying gratification based on some abstract promise of future benefits. And honestly, it kind of sucks. The amounts feel trivial. Your portfolio goes up $30 one day, down $50 the next. The crossover point feels impossibly far away. But something shifts as your portfolio grows. There's a psychological threshold, and it's different for everyone. But for many people, it happens somewhere between $50,000 and $100,000. Suddenly, your portfolio feels real. A 2% gain isn't a few bucks anymore. It's $1,000 or more. You start to viscerally feel compound interest working. Your money is doing something. It's alive. And your relationship to work starts to change even before you reach the crossover point. This is what I call the freedom gradient. Most people think of financial independence as binary. You're either dependent on your job or you're not. But that's not how it feels in practice. As your investment income grows, you become incrementally more free. When your investments generate $500 a month, that's your car payment covered passively. When they generate $1,000, that's your car payment and your groceries. At $2,000, most of your non-housing expenses are covered. Each milestone gives you more options, more bargaining power, more ability to say no to things you don't want to do. You don't have to wait until the line's fully crossed to start feeling the benefits. There's a concept called coast fire. Coast fire is the point at which you've invested enough that even if you never invest another dollar, compound interest alone will grow your portfolio to your crossover number by traditional retirement age. Let's do the math. You're 30 years old, you want to have $1.2 million by age 60, 30 years from now. At 8% annual returns working backwards, you'd need about $150,000 invested today to coast to $1.2 million without adding another cent. If you're 30 with $150,000 invested, you're at coast fire. You could theoretically switch to a lower paying job you love, work part-time, or just stop investing aggressively. Your retirement is mathematically locked in. You've punched your ticket. Now, let me address the objections. Max, the stock market is volatile. What about crashes? What about inflation? These are legitimate concerns. You will experience market downturns. Your portfolio will lose 20%, 30%, even 40% of its value at some point. The average bear market happens about every 4 years. Average decline, 33%. This is normal, this is expected, and it's already factored into the 8% average annual return we've been using, which includes all the crashes, recessions, and panics of the last century. The key is you're not withdrawing money during the accumulation phase. When the market crashes, you're still buying. You're buying more shares at lower prices, which actually accelerates your progress to the crossover point. Dollar cost averaging through downturns is one of the most powerful wealth-building mechanisms available. It only works if you don't panic sell. As for inflation, the 4% safe withdrawal rate is specifically designed to account for it. The original Trinity study that established this rate tested portfolios against historical periods that included high inflation, and the 4% rule held up. Additionally, stocks have historically been an excellent inflation hedge because companies raise their prices along with inflation. Your crossover number will rise with inflation, but so will your portfolio. They roughly track each other. Is there risk? Of course. But the alternative, never investing and remaining completely dependent on trading your time for money until you physically can't work anymore, that's not less risky. It's more risky. Here's what I want you to actually do. First, calculate your current monthly expenses. Not what you think they are, what they actually are. Go through 3 months of bank statements, add up everything, be honest. Most people discover they're spending 15 to 20% more than they thought. This is your baseline reality. Second, multiply your monthly expenses by 12 to get your annual expenses, then multiply that by 25. This is your crossover number at a 4% withdrawal rate. Write it down. This is the portfolio size that would make work optional for you. Third, check your current investment balance. Subtract that from your crossover number. This is your gap, the distance between where you are and financial independence. Fourth, figure out how many years until you close the gap based on your current investment rate. There are calculators online for this. Fifth, ask yourself how you could accelerate this timeline. Could you increase your income through a job change, side hustle, or skill development? Could you decrease your expenses by house hacking, relocating, or cutting vampire costs? Every $1,000 you invest is $40 per year of passive income forever. Every $100 you cut from your monthly expenses is $30,000 less you need to reach crossover. Let me leave you with a reframe. Every purchase you make has 2 costs: the money you spend and the crossover time you sacrifice. When you buy a $30,000 car instead of a $15,000 car, you're not just spending an extra $15,000. You're pushing your crossover point further into the future. At 8% return, that $15,000 would double approximately every 9 years. So that car upgrade didn't cost $15,000. It cost $30,000 over 9 years, $60,000 over 18 years, $120,000 over 27 years. It cost months or years of freedom at the back end of your life. I'm not saying never spend money on things you enjoy. I'm saying understand the true trade-off. Money isn't just money, it's future time. It's the months you'll spend working when you could have been free. The crossover point makes this trade-off visible and quantifiable, and once you see it, you can't unsee it. The average American will earn about $2 million over their working lifetime and end up almost completely dependent on Social Security and retirement, which pays an average of about $1,800 per month. They'll have worked for 45 years and have almost nothing to show for it because every dollar that came in went right back out. The crossover point offers a different path. Not an easy path, but a clear one. Save aggressively, invest consistently, reduce your expenses intelligently, and wait for the math to work. The lines will cross. They always do for the people who stick with it. And when they cross, you'll wake up on some random Tuesday, check your accounts, and realize your money is finally working harder than you are. That's the moment everything changes. I'm Max. The crossover point is real, the math works, and you can calculate it right now. Subscribe if you want more content that shows you the invisible milestones they don't teach in school. Comment your crossover number, let's see where everyone's at. The lines are crossing, the only question is when.